and where the opportunities lie ahead of tomorrow's Fed decision. Dryden Pence is the CIO of Pence Capital Management, joining us now. You heard Seth there talk about how the markets are pricing in. Well, there's not going to be a cut in March. There could be a cut in March, and now back to it. Give me a sense of the reaction to the jobs data, the consumer sentiment data today, and how you think that leads the market setting up for the Fed decision.
Well, I think the important thing to recognize is that consumer sentiment and jobs is the big number. I mean, people forget that this economy is probably doing better than most people expect. We've added 4.7 million jobs since the pandemic. We added 2.7 million jobs last year. That's like all the job labor force of the state of South Carolina. We grew South Carolina last year. So the important thing is the underlying strength of the economy, of the jobs market, and all that is probably better than a lot of people are thinking. And I think that drives this consumer sentiment number, and we look at these improvements, and that kind of moves the date at which the Fed may do something further out and further out and further out. How that affects the markets is those people that are expecting 6 cuts this year are going to be wildly disappointed, and it could be maybe 3, and it could be leveraged towards the back half of the year. That means we'll have a moment where we could get some volatility. But I think that at that moment, it's a buy the dip market rather than chase the rally.
When do you think the best opportunity comes for investors to get in?
I think when the market begins to realize you're not getting 6 cuts. So that's somewhere here in the first quarter of the year where we are going to continue to get stronger data than most people are expecting because we have this large employment pool. And so that's going to be where the market on the interest rate sensitive stocks are going to pull back a little bit because they're going to be kind of reacting to that. That's going to be a good dip. You know, every now and then you get probably one of these corrections. So if you see it in the first half of the year, it's probably a buy the dip rather than chase the rally market, because I think the fundamentals are there across the board. And we see a broadening rally of the entire market, not another magnificent 7, but a broadening rally, because it's all about earnings. You know, for the longest time, it was about fiscal stimulus. It's a story of 3 Fs, right? We had first fiscal stimulus, then we had everybody's talking about the Fed. We're dancing on the head of the Fed's pin. And now, as we move into 2024, it's going to come back to fundamentals. And, you know, companies are beating. And we'll see another quarter of probably 80% of the companies beat.
We have big tech earnings this week, of course, that we're paying close attention to starting this afternoon. But in the meantime, if you're looking for a broader rally, are there specific industries and sectors you think are set for some nice returns for investors?
In terms of the broader rally, this is this time where you begin to look at small caps. So small and mid caps, fundamentals, industrials, those kind of companies are going to begin to come into their for the broader part of the S&P 500 should begin to do better. So we're kind of excited about that. And then, of course, you do have, Amazon's one of the top companies. We think they're going to do pretty well. And we also think we like chips. TSMC is a huge absolute choke point in this, the largest, probably one of the most important companies in the world, because when you think of the chips that they have, they're essential to so many other companies that they put in. And so TSMC is very important, and we think Amazon, TSMC, and small caps are probably a very good area to be in as we move forward.
Hey, Dryden, it's Dom here. If you mention Amazon as the top of that so-called Magnificent 7 pick, does that mean you're staying away from Apple, Microsoft, Meta Platforms, Tesla, Alphabet, any of those big names, NVIDIA?
I think we would prioritize Amazon because, and a little less, it's all a weightings game, right? Apple's not going to have that much growth. The other ones probably are. Tesla's got some challenges in and of itself. The reason why we still talk about Amazon is because if you take a look at the growth going on in online sales, Amazon's 40% of that business. And because they are, if we move, like over Christmas, we had 25% of retail coming on online. If you take that and take Amazon's part of it, that's a $300 billion opportunity that they have. We think they're going to do well through this. We think Apple has slowing growth. I mean, Apple doesn't grow much faster than Procter & Gamble right now. We think NVIDIA still does have some room to run. But again, the world is going to have to catch up, and chips are going to have to catch up with this massive data that's part of AI and going into everything. So we do believe that we're going to continue to see a broadening rally, and then the Magnificent 7, those that have room to continue to grow, are going to kind of continue to do well throughout this year.
All right, that's Dryden Pence. Thank you very much, sir. We'll see you soon.
Thank you. Appreciate it, Dom.